All right, all right, all right. Matt, the mortgage guy, live and direct, Monday, 3 p.m. Pacific Standard Time, answering all your questions about mortgage, real estate, what's going on in the market, what I'm seeing, hearing, feeling. I may not be the smartest dude in town, but I can tell you what, I have a lot of real estate conversations with a lot of really smart people. So I'll take everything I hear and see on the streets. I'll relate it to you. Feel free to jump on, ask any questions you may have. There is a ton of information out there, some good, some bad, some of it somewhere in between. What's up, Ryan Lundquist? Glad to see you here. I'm actually going to share some stuff from SacramentoAppraisalBlog.com today because, as I was poking around, trying to get a feel for what people are saying, either collaborate that with what I'm seeing and hearing, with conversations with real estate agents, conversations with clients every day, to bring to you my honest opinion on it, right? We've still got record high home prices. I think people like Ryan Lundquist and myself, agents I'm working with that are working in real estate, you can feel the change, right? You can feel a little bit different. I don't even know what the right word is, but the temperature has changed for sure with the demand side, with buyers entering the market, right? Everything that the Fed has said about raising interest rates to diminish demand, like it's worked so far, right? It's yet to show up in a lot of the stats. It's yet to show up in how, much of an effect it's going to have on the market. But for sure, you jack up interest rates in a fairly short period of time and change like buying power, change affordability for a lot of buyers, it's going to affect the real estate market, right? Like Ryan Lundquist and I like to have discussions around everybody thinks that everything's bought with cash. 85% of the stuff in the market that we work in and live in is bought with financing, right? So the terms of financing are going to affect buyer demand, are going to affect the real estate market. The same thing can be said, and I was listening to a really great conversation this morning about valuations of companies. The valuations of companies and the stock market, and a lot of stuff you're seeing in the stock market is also directly correlated to interest rates. When you can borrow money and these companies can borrow money at one rate, and then that rate changes, it affects the company's valuation. And like the Fed is just getting started. If they're able to get that Fed funds rate to 3% or 4%, it's going to further not only affect the stock market and companies involved, it's going to affect the real estate market and all the buyers involved because the cost of capital, the cost that we're going to have to pay on mortgages is going to change. So really interesting stuff. I wanted to start out with some data I was looking at where if you just see the data and you just hear the numbers, you might think one thing, and then you take it in context and it might mean something different. For example, inventory week on week up 8%. 26,000 new listings came to the market in the last week. These are big numbers that feel like, holy moly, here's the start of something crazy, a big shift in the market. Know that this time of year, like literally for the last 5 years, the third week of May exactly is the week where we see the biggest increase week over week in inventory. So is 26,000 a big number? Yes. It's the biggest number we've seen in week over week inventory increase since 2016. I'll give you that. But having that 8% week on week uptick, is it super surprising or is it out of the ordinary? Not necessarily, right? Because this is the time of year where more inventory comes on, right? We're getting ready for buying season for the spring and summer, real estate market where more homes are listed, more homes are sold. When you look at it year over year, we've got 6% more inventory than this time last year. So inventory is up. I think people probably notice that. I think buyers can feel that. And it's a good thing. We're having two things happen that have a positive effect for buyers. Increase in inventory, decrease in demand. I'm sorry, I probably like did these backwards, right? Because it's getting us closer to a level market. Now, after I say that, don't think that overnight we're going to go from having to put in an offer that might be 5% above ask to all of a sudden be able to put it 10% below ask. I just talked to a listing agent this morning on a property in San Diego, listed at 1,495. Our clients were offering 1.66. We weren't even in the running. Listing agent was really straightforward with me and said, hey, Matt, I just want to let you know, like, I'm straight with people. It's probably going to go somewhere near 1.8. I was like, gosh, dude, like that's 20% above ask. Given that I understand that asking price doesn't mean much, right? It's just where you start. This same agent could have listed it at 1.8 and 1.8 could have been asking, right? Listed it at 1.5, pretty aggressive probably to garner 5, 6, 8 offers and get, whatever the market's going to bear, whatever someone's willing to pay. But it's an example of, let's not, although I'll admit the market has changed, let's not think that overnight we flipped to a whole new market. We flipped to a buyer's market. What's up, Matt? What's up, Ryan? What's up, Mona? Thanks for joining. As always, folks, every single week I'm here. I'm giving my opinion. And I'm going to share, like I did for these last 7 or 8 minutes. What I really, really enjoy is questions that we can bounce off each other. Throw any questions you have at me. If you don't have questions right away, I'm going to do something that I was thinking about, and I'm glad that Ryan's on here. I'm sure that Ryan is more than cool with me sharing his stuff. Something that Ryan put out last week, and this is something that I think is really just spot on. And the reason I want to share it, the housing market is different than it was 2 weeks ago. It's different than it was 4 weeks ago. Sellers only look at the sunshine and the rainbows and the 100,000 above ask that their neighbor got 3 months ago when they listed it X price and went 100K above ask. So sellers are probably going to act a little unrealistic. This listing agent I talked to this morning, great conversation, reminded me, sure, I could have listed at 1.8 and there would have been some agents that said, sure, let's list at 1.8. And then it might have sat, got no action. And then I have to lower it to 1.7. Instead of that, listed at 1.5, 5, 6, 8 interested parties that are so interested they're going to write, going to entertain a counter offer, and then he'll sell for 1.75, 1.77, right? It's just an agent who's strong enough to tell a seller, listen, here's where we should list and here's why. It's much better to list it a little bit below than list it above, especially right now, right? And more than ever, like you've got to have a top-notch real estate agent, whether you're on the buy side or the sell side. This is an open letter to sellers that I'm going to share. Ryan Lundquist put this on Sacramento Appraisal blog. If you want to check it out for yourself, just go to sacramentoappraisalblog.com. But I think that it's worth going through because it's just pure gold, right? Some things for sellers to think about. Number one, you've lost power. Still probably a seller's market, but like we go from a super seller's market to a strong seller's market or a somewhat strong seller's market. Like it's not the same as it was February and March. Granted, every market is different, but a lot of markets I'm looking at, a lot of markets that I'm working in, this is spot on. Like you're not getting 8, 10, 12 offers. You might get 3. So don't go in thinking that you've got more leverage than you do and do silly stuff. Make decisions like, oh, hey, we got a great offer that was above ask, but they didn't release their appraisal contingency. They're only willing to write 50,000 above. So we're going to wait. We're going to give it 4 days before we look at something else. Because I promise you what's going to happen is sellers who are unrealistic are going to pass good offers. That person's going to have an expiration date or they're going to rescind the offer and they're going to be on to the next one. And this seller is going to be stuck saying, Where's the rest of the offers? And they might not come, right? So, like Ryan says in his last line here, if you've priced too high, you'll probably get 0 offers. Sellers are going to find this out. I had one listed in my neighborhood, which I knew from the start. Give this thing 2 weeks and it'll get reduced. They just started too high, right? And it's not a matter of home prices are coming down. It's a matter of, if the last comp that sold was at 580, list your house at 575. Let the market dictate whether someone's going to pay 580 or 585. Don't list it at 615 hoping for someone to pay that. You'll see real quick, no offers, reduced to 575. I literally called it when I saw it, talked to a couple local real estate agents about like, why in the heck are they listed at 615, and saw the price reduction happen, like as predicted, right? Number 2, buyers are growing more sensitive. 100% agree. Buyers just like, they have to be more sensitive because they qualify for less than they did last month and the month before. So they're a little bit weary. They're a little bit, more fearful, to be quite honest and like straightforward about it. Like, the buyers I'm talking to are just like, you know what? Like, we're going to get this right. We're going to do this right. They're already, a lot of them, at the max of their budget. So as they see more stuff come onto market, they're going to be like a little bit more choosy about what they offer on, right? And when they offer at 580, and they've got certain things in place to protect themselves, like, this might be a little bit uncomfortable for them. You can't just like counter them at 600 and expect them to go, okay, cool, and sign away. They're more sensitive, and you need to be aware of that as a seller. The price is wrong. Don't aim for unicorns. This is something that happens in our market. It's probably prevalent in a lot of markets, right? Like, you might get one buyer, and I've got an agent, I won't name the area, but this agent got an offer for 100,000 above list. And there was one buyer willing to write that high. The next highest offer was like 80,000 below. So if that one unicorn buyer didn't come along, this seller would have got $80,000 less. Some sellers now, with more inventory on the market and buyer demand coming down, so there's less buyers out there, are going to aim for that unicorn and be like, I really want to get 700. That's not going to happen, right? Like, there might be a few people willing to pay around 640. It's the last thing in this neighborhood that sold, like a comparable, sold for 625. You should be ecstatic about getting 640. But for whatever reason, they're aiming for 700. Oh, 640, 700, it's all the same for somebody coming from the Bay Area. Like, let's go for that. Just not going to happen. But Zillow says that's one that never gets old, right? Everyone looking at the Zestimates and for whatever reason, their algorithm says it's higher or lower. I've got a couple properties I own. Like, actually, I've got some on both sides. Some where Zillow says a crazy number. I'm like, I wish it was worth that much. And others where Zillow says like 200,000 less than it's really worth. So don't count on that. They probably get it right on 85% of the Zestimates. They're within a range, but on some of them, the algorithm's just going to be off. Avoid strong arm moves. This goes back to what I said earlier, right? You used to be able to counter as a seller and ask for everything, including the kitchen sink. You can no longer do that, right? Instead of having 8 to 10 offers and 2 or 3 of them would do whatever you said, you have 2 or 3 offers. And if you counter with these strong arm moves, give us your highest and best, remove this contingency, have this contingency fall off in 8 days, you're going to get buyers that walk. Sales are old and crusty. This is super true. And I don't think enough people understand how this works. When you're looking at data that's published, know that whatever sold in April went into contract in February or March. So the things that buyers had to do and the things that sellers could demand in those months with no inventory and a ton of demand have changed drastically in the last 60 to 90 days. And so that April 24th closing that got into contract the end of February or whenever it got into contract, like the times were different then. It's 60 to 90 days ago when the market was different. So you can't really use that data to guide how you're pricing today, right? Because we're in a different market, like it or not. Be ready to negotiate if needed. I'm seeing more of this, right? Where like you just got to be realistic as a seller. You've got to have a strong agent who's going to tell you the truth. Listen, you can do this, you can't do that. This is a good offer. I'd take that. We can counter this. I wouldn't ask for that. All these things that really points back to have yourself a highly qualified agent. I was talking to an agent this morning and they reminded me, and I was in agreement with them. You pay the same, which is zero when you're a buyer, whether you have the best agent in town or you've got the newest agent with the least experience who works 2 full-time jobs and then does real estate on the side. Same exact price for those, which is nothing. The list side, the seller pays the buy side agent's commission. So you're not paying anything to the agent. You can have the very best. You can choose the best in the league, or you can choose somebody who's in AAA. It's up to you. I would probably choose an all-star. Not time to push the price. That kind of goes without saying. You're not going for records. You should list at a price that's aggressive, so that if the last thing that sold was 580, you list at 569. If your house shows well and is priced correctly and there's enough action, you're probably going to get 580, right? Prices aren't coming down. But for listing it at 620, you're doing yourself a huge disservice. And number 9, tighten up the details. Buyers have become more sensitive about condition. I mean, trust me, I work with hundreds of buyers. Buyers will back out of your deal. They will. If you're not willing to pay $4,500 towards the $10,000 in repairs that they've identified on their initial inspections, they're like, you know what? Since getting into contract here, I saw a couple other ones I like. I see more inventory. I see 8% more inventory coming on. We're good, right? So as a seller, be careful. Don't shoot yourself in the foot by digging your heels in the sand and then go accept an offer 10K lower 15 days from now and end up getting 10K less, but being like, I showed him I didn't pay $4,500 towards his repairs. You'll probably pay $4,500 towards repairs on this new one and take $10,000 less on sales price. So there. Okay. Watch for symptoms of softening. Days on market increasing, happening, less offers, happening, less traffic for listings. I can tell you with 100% guarantee, I walked through open houses this weekend. I talked to agents, less traffic, more credits offered to buyers in some scenarios, right? More price reductions happening, listings priced lower than sales. Don't know if I see that happening yet. Lower sales. Don't think we have things that are selling for less currently. But yeah, don't expect 100,000 over, depending on where you're at, right? That San Diego one's going to go 300,000 over. Anything else you'd add to this? Go to SacramentoAppraisalBlog.com. Give Ryan a shout. Say, I saw this on Matt the Mortgage Guy's live stream. It's great information. This guy puts out some of the best stuff. Whether you're in Sacramento or not, I think it's useful real estate information to go check out. So I would go check out SacramentoAppraisalBlog.com. Ryan does a great job. Thanks for being cool with me sharing that, Ryan. Always enjoy reading your stuff. I'm sure there's more stuff coming to the blog this week. Good evening, Kevin Hawthorne. Thanks for joining, my man. Appreciate you from Florida. Al Bundy, if you co-sign on a mortgage for a family member who makes all the payments from their bank account, does that hurt your ability to buy another property for yourself in the future? Not necessarily. What will happen is if you co-sign for somebody and they're living there and they're making all the payments, we can omit that debt. So it wouldn't affect your debt to income ratio. We're going to want to see 12 months of payments from that person and some sort of letter explanation saying, hey, I co-signed for my uncle. My uncle makes all the payments. My uncle lives there. And whatever proof the lender's looking for sure they're going to want a 12-month history of payments to show it coming from Uncle Johnny's account to the mortgage company. The crazy part is the guidelines are pretty clear on that. Some people will say, oh, I've got 12 months history, but this 1 month it came out of, Aunt Sue's cousin's account because we gave her cash and this thing happened. Like that stuff can affect you as a borrower. So just be aware of that. Like make sure that you've got the documentation to kind of prove and have that debt omitted. All right, Tim Mack. If my wife is on FMLA for having our baby, can we use her income now or do we need her to go back to work? If we can use her income now, will the underwriter use the pay stubs before she went on FMLA? The best way to do it, because it's different for every company, and some companies structure it to where she's going to get paid the same when she's on maternity leave and when she gets back. Maybe she's getting a portion of her pay right now. Depending on when she's going back, let's say she's going back August 1st, right? The best thing to do is get yourself pre-approved, get something from the employer that says, starting August 1st, 2022, Angela's coming back. She'll be receiving full-time, full pay as of that date. And we're able to use that as long as no payment is due on your new mortgage before her back to work date, if that makes sense. Plenty of these scenarios that we've worked with, I would say get yourself pre-approved with a mortgage broker you like and trust. It might be that, like, given the income she's got now, you guys qualify for plenty. And sometimes I get people who are like, all these scenarios and, hey, what about this? What about that? I'm like, listen, if you're going to buy something for 700 with 20% down, like you're well qualified. You can go up to 1.1 million with the current income we have on the file, whether she's making $6,000 a month or 9,200 a month when it's full-time, full pay and back to work, like that's kind of irrelevant. So I would button that up. And just another reminder, full pre-approval, high quality mortgage broker who you like and trust that's giving you good information. A great segue to say, if you want to connect with me and my team, greatmortgagebroker.com. We're at 46 states. By the end of the week, we'll be 47. By Q3, we're going to be in all 50 states. So no matter where you're at, we're happy to help. Go to greatmortgagebroker.com, fill out the form, let us know where you're at, how we can help, and we'll be in touch shortly. We're getting to the point where you should see a response from us within a few hours. At the very most, you contact us at 9 p.m. We might be back with you the next day, early morning, but we're going to get back to you. We've got, we're on a mission to serve at the very highest level. And that's from the very first conversation we have, all the advising we do to get into contract. And I can tell you with absolute certainty, once you've got into contract, the experience you get from contract to close is first in class. Best in class is what I meant to say. I'm thinking about Jack Harlow, first class, but best in class service from contract to close. And we're working on getting better every day. Hopefully that answered your question, Tim. If you sell with owner financing, you probably still charge a premium. Yeah, I mean, you're probably right. If you're doing some sort of seller financing, someone might be willing to pay your price if they get some terms on the seller financing. The $1 million question. 25 minutes in, but we gotta have it asked because I am a mortgage broker. This is a mortgage channel. What do you think interest rates will do for the rest of the year? Is essentially what you're asking. And in full transparency, no crystal ball. I don't have as many awards as Barry Habib, but I will tell you my 2 cents. I think that all of the stuff that the Fed's going to do has been fairly well projected and fairly well baked into current mortgage interest rates. If you guys have been following interest rates really close, we've actually seen interest rates trickle down slightly. I had some clients reach out to me and I know rates keep going up, like send me the latest rate and how much I qualify for now. And I said, hey, listen, we looked at them on the 7th Now that it's the 22nd, your rate has actually got slightly better. It's trickled down from 5.375 to 5.25 for your scenario. So getting back to your question, I think that we won't see a ton more increase in interest rates, which some people will be like, what do you mean, Matt? The Fed's going to continue increasing the Fed funds rate and it's at 0.75. If it goes to 1.25, 1.75, 2.25, 2.75, they got 5 rate increases left in 2022. They might bring the Fed funds rate all the way to 3%. How can that not affect interest rates? Not directly correlated. A lot of stuff that's baked into mortgage interest rates, the mortgage-backed securities and how they are traded, we already know it's coming, right? So it's already baked in. My best guess is interest rates will not go above 6%. Could they go up to 5.75? Sure. Could they hit up against that 6% ceiling? Sure. But I don't think they're going to go to 6.5% by the end of the year. We've seen quite a bit of increase. And, people that were looking in January at the low 3s and now we're at the low 5s, like it's a full 2% increase in the last 4 months. I don't see much more increase in the future. A lot of folks are thinking that, we may have already seen the top, or at least we're very near the top of mortgage interest rates. Once we get past taming inflation, once we get past, whatever type of recession we might see in the economy, the Fed's going to be able to pull back the same lever that they've pushed forward to tighten and to take the Fed funds rate up to 3%. And they're going to pull back and start, doing some more quantitative easing. And we might see interest rates back down below 4% sometime next year. I've got no crystal ball. I can't say if that's for sure going to happen, but it's a possibility. All right. Matt Bittner, has Zillow estimate improved over the years? I would hope so, right? They've got more data. They've got people working on all of that stuff that goes into the algorithm to better estimate home prices. So it's probably gotten better. I haven't seen any data specifically on has it gone from a 5 or 6% range of how accurate it is to a 2% or anything. I don't know any exact numbers, but I would say it's probably safe to say it's gotten more accurate. Basilio, thank you for joining. What interest rates do we have for investment properties? High 5s. I think I just locked one in at 5.875. Granted, on the investment property stuff, it's more common to pay points. And a lot of times people are looking for cash flow. So they're locking in paying points. Let me see. I'll do a quick scenario for you, Basilio, because you're a loyal follower. I'm logging in right now on my other screen. So bear with me. I'm going to get you some real-time pricing on investment property loan. We'll just do 400,000 with Basilio with a $300,000 loan amount, 25% down. And we'll see. I'm guessing you can get in the high 5s for less than a point. That's my guesstimate. Investment property, single family, good credit. Disclaimer, this is not an offer. This is not me putting anything out there besides a range, right? NMLS number 1088993. I'm not quoting rates. I'm just giving some what ifs. Just some guy on YouTube. All right, Basilio. Yeah, it cost you about a point to get a 5.875. But when you look at the rate sheet, depending on credit score and stuff, it may or may not make sense. It probably does. You're able to get a 0.5% in rate for a point. And so that's $3,000, saves you $120 a month. 3,000 divided by 120. It's like a 2-year break even. Most folks are like, yeah, let's lock it in 5.875. I'm going to keep this thing for at least 2 years. And, buy and hold investors, they want that extra 120 in cash flow. So 5.875, less than a point, to be honest, but close enough for government work, is what you'd see on an investment property loan, like, closer to 6.25 without paying any points and no fees whatsoever on the lender side. All right. Hopefully that was helpful. I live in Rancho Palos Verdes, which is LA County. Lots of people in my area know that I do loans, and I've been advising even one single offer 5 to 10% over asking, bite on it. Yeah, that's good. I think you're referencing like to sellers, like take it, right? Don't step over dollars chasing pennies. That's good advice, brother. And I think some sellers are going to listen and they're going to, do the right thing. Others are going to be stubborn, and some of them will get bit, right? And they'll end up on the market longer, eventually selling for less, which, full transparency, when you start at a number that's not the right number or it's too high and you do price reduction, sell, you might sell at where the last comp was. That doesn't mean home prices are going down. That means you were unrealistic to start, right? And so buyers shouldn't get confused thinking price reductions means like the home prices are going down, because they might not be. Everything around you might have sold between 550 and 580 in the last 3 months. This new listing goes on at 630. Wrong. They screwed up. If it eventually sells for 580 after 2 price reductions, home prices aren't coming down. They're staying flat, or maybe that's 3 to 5% above what the last model match sold for. They just initially started too high. Javier Vidania talked about the rise of ARMs. Should buyers consider going down this path again, or too risky? When is it not a good idea for a buyer? This is a great question, because ARMs are like 11% of the mortgage market now. And like more and more stuff coming out. Flagstar is a bank that does a lot of ARMs. I think I read an article this morning from somebody on their executive team about adjustable rate mortgages. If anyone's unclear what an ARM is, it's an adjustable rate mortgage. May sound really scary to folks, but keep in mind, when you hear the term 5-year ARM, 7-year ARM, 10-year ARM, that 5, 7, and 10 is the number of years it's fixed. So it's a fixed rate loan for 5 years or 7 years or 10 years. Then it's adjustable, right? Then it starts to adjust. It will adjust up to a certain amount every 6 months usually, right? And there'll be caps in place where like it can't adjust more than 1% or can't adjust more than 2% in any given period, right? But it does adjust, meaning you might get a great rate of 4.125 and you're saying, wow, this is great because it's a full percent lower than what I could get on a 30-year fixed. Know that it can adjust, and you don't want to be in a position where 5 years from now, 7 years from now, when it's due to adjust, you either don't have a plan or you're not able to get financing. That's the biggest thing I think that I want to warn people against is if you're in a position where you've got great income, you've got predictable income, you've got a stable job, you're going to be able to qualify to refinance into a fixed rate product later, great. If you have a plan, knowing that, hey, I'm going to sell this thing in the next 5 years for sure. I've got a kid who's going to be in college in 2 years. We're empty nesters. We're planning to move to Arizona. We're going to move to Florida. We're moving to Tech. Like this house for sure is going to, like, we're going to sell it in the next 4 years. Well, then great. Getting in an adjustable rate mortgage that saves you on a monthly basis might be an option. The thing about it, Mona, and for anybody listening, is that you got to know what you're getting into. This is a great product for a lot of people who, really have a strong financial position. And they look at a jumbo loan that might be 5.25 on a 30-year fixed and 4.25 on a 7-year ARM. That 1% spread, if you're borrowing $1 million, is $10,000 a year, otherwise known as about $825 per month. If you've got a plan to exit, or you've got a plan to refinance, or you've got something, $825 a month is real. That's some real money, right? So you probably want to consider it. At least consider it, right? I never tell somebody you got to do this, you got to do that, but you should consider it. $10,000 a month in savings, be in that loan for 5 years, save 50 grand in interest. That's a big deal, right? And so that's when it's a good idea for a buyer. When it's a bad idea for a buyer is when, especially to Mona, like the jumbo loans, 1% spread, $1 million being borrowed. If you're borrowing 200,000 and the difference is 0.25% or 0.3%, we're talking very minimal upside, very minimal benefit. And you got to weigh the benefit versus the risk. There's risk in adjustable rate mortgages. It's just the truth, right? And so I think that's my 2 cents plus an extra couple quarters I threw in there. I probably gave my 52 cents worth right there, but hopefully that helped. Yeah, I mean, I think rent appreciation is real. I don't know. I haven't done enough research, Matt, to know like the housing shortage on both the sale side and for buyers and for renters, all the contributing factors to where we have like a 0.8% vacancy rate. It's like a historic low. There's nothing vacant, meaning like an available unit to either sell or to rent, right? Because in order to have more inventory so that home prices stop their 20% per year appreciation, we need more inventory, which I think is coming, right? And for rentals too, like when you've got 12 or 15 people wanting to rent the same house, it makes sense that it's going to rent for a premium. You're going to be able to rent a 1-bedroom house in a decent neighborhood for $2,000. Like, this stuff blows my mind, but it just is what it is, mainly due to supply and demand, right? Tanisi Adams, hello. Thanks for joining. Where do we go? Can you point me in a direction for first-time home buyer in New Jersey? Happy to help. For sure. Go to greatmortgagebroker.com, fill out the form. Connor, who's on my team, licensed in New Jersey. So he's going to help you personally, right? I've got, a network within U Mortgage where I'm going to make sure that you are with a high-quality loan officer in the state that you're looking to buy. If you're in Colorado, Iowa, Maryland, New Jersey, Ohio, Pennsylvania, Tennessee, Texas, or of course, California, my home state, we're going to personally take that stuff. So New Jersey, go to greatmortgagebroker.com, fill out the form. Connor will reach out to you personally. Connor will see to it that you're pre-approved. Connor will see to it that you know exactly what you qualify for, and he'll hold your hand all the way till you get your offer accepted, and then we'll put you through the amazing U Mortgage process, which is, best in class client experience. So go to greatmortgagebroker.com, fill that out. We're happy to help. You know what? I only heard a little blip about this. When you're hard charging and growing a business and working 14 hours a day, making sure that, client experience is A+, you don't have a lot of time to read and hear about everything. But in one of the meetings I was on today, somebody mentioned monkeypox. I'll look into monkeypox. I really hope we don't see a second pandemic. I know and this is another thing too, where like, I'm not speaking on stats. I'm speaking on personal experience. I have personally heard more stories of COVID, from colleagues, from people in my network, from, folks I work with, like it feels like we're having a wave of COVID. I hope that everybody's healthy and fine and getting through it. Some sort of herd immunity is on the way. But yeah, I mean, I hope for businesses' sake, for schools' sake, for people's health and safety and all that stuff, that we're not entering a second pandemic. If we get to the point where, COVID is something that we live with and we learn to deal with, and we've got, a COVID shot, like we've got a flu shot. I don't know. That's probably what my hope would be, right? Eurodollar is predicting negative interest rates next year. Imagine too, if we overcorrected, we raised the Fed funds rate, we got inflation so far under control that, our economy went into a recession, and then the Fed just went bananas with the Fed funds rate and just went chop, 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 chop. We went below zero. I saw something crazy. Somebody's talking about a 1% mortgage interest rate. Get the heck out of here with that nonsense, dude. That ain't going to happen. Is doing loans in so many states spreading you thin? More employees? Yeah, I mean, we're expanding all ways, Al. So yeah, I mean, I'm not personally getting spread thin because I'm just overseeing every aspect of everything. The best people in place, like the folks that are on the team, whether it be the California branch that I've got here in Sacramento or corporate resources out in Philadelphia, trust, Al, that the client experience is only getting better, right? People are getting served at a higher level. We've got capacity to do 1,000 loans a year and have the client experience be A+, right? So lead in from the very initial conversation that happens after they fill out a form on greatmortgagebroker.com, from that lead intake to it getting submitted to the loan getting to the finish line, we've got very best in class folks every step of the way. So yeah, short answer, long answer, more people to handle more business, but doing it the right way and scaling with the one and only important thing being considered every step of the way: client experience. Was there something only carry, no PMI? Owner carry PMI? Did I miss something different? Did I miss the first part of that question? Owner carry PMI. No comprende. Crazy. I bought my house at the right time. Rates are high. Yeah, I mean, I think eventually it's just time in the market versus timing in the market. Sure, you bought whenever you percent interest rate. Someone's going to buy today. They're going to have a 5.25. They're going to look up in 15 years. They'll have refinanced it twice, and they'll be in whatever rate they're in. They'll have it halfway paid off. It'll be worth 62% more than it's worth today when they bought it. And so, with a long enough time horizon, everyone's a winner in real estate. I truly believe that, right? When people told me I was an idiot in 2006 for buying when I did, I watched the, up, down, sideways of the market, went from 6.75. I think I refinanced it once in 11 or 12. Then refinanced it again in 2016, and then refinanced it again in 2020. So now on an investment property, because I've moved out of that property 5 years ago, I've got an interest rate in the low 3s. The thing is worth roughly 60% more than I bought it for in 06, which people thought oh, it's never going to go back to those prices. You paid $345 when it went down to $180, right? Now it's worth probably 550s conservative, right? And so it's a 60% increase. If you hold for decades, which a lot of people I know just buy real estate and don't ever sell it. You go and win. I can't imagine rates ever coming down to 3%. They might not, right? Like 3% might be something that we never see again. I was looking the other day. I've got 6 mortgages, and I've got all of them somewhere between 2.5 and 3,375. And I'll tell you, the 3,375 is a 4-unit investment property. So before you tell me, like, why didn't you refinance that into something lower, since you've got access to the best rates and you're a mortgage broker? 4-unit investment property. That thing is smoking. Anyhow, it's a good feeling. I mean, this is a good question. Hypothetically speaking, what factors would push the interest rates to go above 6%, and what factors would cause the interest rates to go back down? I think there's a lot of different factors. Generally, when there's economic uncertainty and there's wild things going on in the market, like that will push interest rates down a little bit. What could push interest rates up is if we start to look at CPI data and inflation data and realize, like, man, even with all the things that the Fed is doing, it's still not bringing inflation down. Inflation was worse than we thought. We need to do even more. So if the Fed does more than they've kind of projected or talked about or laid out to do some quantitative tightening, push interest rates up, and they push the Fed funds rate to 5, that would certainly cause interest rates to go up. Like I said earlier, I think that most of the things that they're currently doing, 50 basis points next month, 50 basis points the Fed meeting after that, like, that's already expected. So that's not going to affect interest rates. But if they have to do more than that, or for whatever reason Jerome Powell just feels gangster and just wants to do more than that, wants to get tighter, wants to go a little bit more aggressive at this inflation thing and do that, then that could cause interest rates to go higher. Hey, Mona. Yeah, I had this same question for buyers, and there's different factors involved in this, but if you guesstimate $50 to $60 per 10,000, that's a good estimate. For every $10,000 increase in house price, $50 or $60 more for the payment. And it works the same way inversely, where people are like, well, what if I put an extra $20,000 down? How's that going to affect my payment? Well, probably going to affect it between $100 and $120 a month for that extra $20,000 you put down. Do you agree with Tom Ferry in that millennials are powering the spike in home value demand, and therefore there will not be a housing crash, but if anything, a plateau of prices? Yes. And I think that anybody who follows housing demand and that knows that there's certain demographics that buy more homes than anybody else. That demographic is always like shown 34 to 36-year-olds. They're forming households. They're getting married. They're having kids. They're buying homes. Like the data supports that. So if you have more people 34 to 36 years old, which all you got to do is go back and say how many babies were born in 88 and 90, or 88, 89 and 90, you'll be able to see, right? And like that graph, I've seen it before for 34 to 36-year-olds. It goes like this over these next few years, 22, 23, 24. So I think that like what we saw in 20 and 21 was less demographic and more to do with interest rates. Like pulling down interest rates just would put so much fuel on demand. It was gasoline on demand. And so I think that was more interest rate driven than demographic driven. So as interest rates go up and that quells demand, the up pressure from millennials, 34 to 36-year-olds especially, is going to cause that demand to flatten. or home prices to flatten, right? Demand's going to come down because of interest rates and affordability. It's going to be met by a bunch of millennials who are like, hey, listen, we're married, we've got 2 incomes, we want to buy a home because we just, are planning on having our first kid. All that other stuff that happens is going to contribute to, instead of a 10, 20% decrease in prices because of the affordability and the increased interest rates, we'll meet at zero. Home prices will be flat. I wouldn't be surprised if we saw 12 to 18 months of flat home prices. It would be great for the market. I would certainly welcome it. Okay, Kyle in Pennsylvania. Should I expect a bank statement loan to always be 1% to 2% above the 30-year conventional rate, or afraid to go up to 7%? Would there be a bank willing to lend at 7% without tax returns? What I will say is the bank statement loans that I've seen, if it's going to be a owner occupied, you could probably find it 1% above the 30-year conventional rate, right? So if 30-year conventional is 5.25, you can probably find it at 6.25. I want to say, man, if I look for it, I probably won't find it. So I won't bore everyone waiting for me to find it. But we just priced one out on a bank statement loan for somebody who's buying owner occupied, and I was surprised at how good that rate was. So I would say 1% to 2%. I would still use that as your range. If it's owner occupied, closer to 1%. If it's an investment property, closer to 2%, higher than the 30-year conventional rate. When I talked to someone recently, I just said for conventional owner occupied, call it 5.25. For investment property, call it 6.25. For bank statement or DSCR, call it 7.25. Sure, you could probably do better than that on all 3 of those, but just as a rough estimate, that's probably where you want to at least think about where it's going to be. Because some folks are going to have worse credit, smaller down payments, and higher rate than that. Some are going to have slightly better. A Balestra. How do you assist clients with 1099 income but have only worked for a few months? It's my understanding that 1099 buyers must have 2 years of income history to apply for a mortgage. If you're self-employed, 1099, you do need 2 years of history to get conventional financing. If, there's some caveats to it. If, you're looking for some sort of non-QM loan, those ones a lot of times even want you to be self-employed for a certain number of years. So I'm not sure if you can be brand new to 1099 income. If you've been self-employed for 5 or more years, the income just hasn't been great until, let's call it, last year. Know that you can get a conventional loan with only 1 year of tax returns and just take into account 2021. But in that case, you'd have to be self-employed for 5 years or more. It's so scenario specific that it's hard for me to answer, general stuff other than to say, get yourself pre-approved with, a mortgage advisor who knows their stuff. They'll best guide you. Sometimes people are going to give you answers you don't want to hear, but it's just the truth of the matter. How do clients go about refinancing? Thought I had this thing on mute. Assuming interest rates go down within the next 3 years, can buyers always refinance interest rates are low, or can they be denied? If you qualify for a mortgage today and you continue to work and you have the same type of income that you qualified for today, similar type of debts, you're more than likely going to qualify in the future. I say more than likely, and I don't say for sure, because we don't know what mortgage guidelines look like next year, the year after that. But I would say if you've got a stable job, you've got stable income, you're able to qualify, your credit's good, you should expect to qualify in the future and refinance. And there's no nothing against it, right? People that bought in 2018, refinanced in 2020, they refinanced again in 2021. Rates went down. They're able to say, I'm in a great mortgage at 3.75, but shoot, now I can get 2.625. I'm going to go and refinance into that. So no, harm in refinancing in the future as long as you qualify. Matt, I don't know if you were listening, but I said my best guesstimate for housing, we've been like this. We are going to go like that. And we're going to see home prices flatten out. The smartest people see that there's going to be less homes sold in 2022, which is a decrease in the number of closed loans, not going to mean a decrease in pricing. I think if we look next year at year-over-year home prices, it's going to be somewhere between the 0 and 5% home price appreciation, 3%, 4%, 5%. I don't think it's going to go negative. And I also don't see any scenario where it goes up another 15 or 20%. That would be ludicrous. Crash, no. As wages go up and some of the inflation gets cooked into the cake, inflation will go down. Low rates will settle in too. Yeah, I mean, I think loan rates have kind of already settled. We've seen that kind of, the last few weeks at least, loan rates start to settle. So I'm looking forward to it. I'm looking forward to a fairly flat home price appreciation. I'm looking forward to more inventory. I'm looking forward to loan rates staying pretty stable and, possibly going down in the future. So it's going to be not cheaper, but easier for buyers in the future. That's my hope. That's what I'm hoping for the 100+ folks I got pre-approved that are out there home shopping. It's probably up to 200 now, but anyhow, that's just my hope and what I see. I really appreciate everybody who joined. I got in a good hour today. If you've got more questions, feel free to reach out to me. Go to the YouTube, post some questions. I try to answer as many of those as possible. Feel free to ping me or my team at mtmg.com. Or if you're looking to get yourself pre-approved and want to, find out what you qualify for, get some good information about that, go to greatmortgagebroker.com. Thanks everybody for joining. I really appreciate you. Keep the questions coming. Let me know if there's videos you want me to put out. Tomorrow's video is going to talk about things to look for when you're pre-approved in 2022 and looking to buy. More than just the housing market and what's going to happen with the housing market and all that yeehaw that really gets pushed by the YouTube algorithm. I'm going to start putting out more and more specific mortgage related content, things to think about with your mortgage, because that's really my area of expertise. The real estate stuff I comment on because I'm in it every day, watching it, talking about it, having conversations about it. But let me know if there's anything specifically you want to see. I'm more than happy to make a video on a specific subject. Thanks again for watching. Until next time, we gonna see.